This is a video on my stock pick for, let's see, Monday, April 25th of 2011, and we are looking at Garmin. Now, this already looks like a mess, and it's because, let's say in this area right here, I was looking at it saying, oh, that looks like a rectangle, so I traded it, said, all right, buy at 32.10 and sell at around 34. Problem was I didn't have enough buying power to actually make the trade, but if I would have made some money. Anyway, I'll get rid of these drawings just to clear some things up. I don't want to be confusing my viewers here. Anyway, Garmin, to those who are unfamiliar with the company, makes GPS systems as well as other things. So let's see, I'll get rid of that. Still cleaning everything up. Actually, let's make this a solid line. There we go. Okay, so right here we have in this area that I'm highlighting, we have a descending triangle. And descending triangles are some of the most dependable patterns in terms of pattern trading. And let's see, get that out a little more, make it even more clear. And surprisingly enough, even though this is usually a bearish biased pattern, a breakout to the upside, which is kind of rare, is extremely dependable with a, according to the Bolkowski study, one moment, 84% of upward breakouts meet their price target. So we have a very good chance of making some money on this. And I'm actually going to be entering this trade tomorrow morning, so I want to give all of you a chance to get in as I do. So we have the breakout right here, and the breakout is on increased volume, as you can see right here, increased volume from the last few days, and it breaks out from this trend line. And then the next day was also an up day slightly. So what can we do tomorrow? We want to get in the trade. Oh, first off, I'll say that our target is $36, and our stop level, let's see, zoom in, get a better picture of what everything's going on. Our stop level is $33.74. Alright, now what do I think is going to happen? Looking at the stochastic indicator, no, that's not helping too much for that. So let's try to make an order, because it might gap up again tomorrow, which might pose some problems. Alright, we will enter the trade at we'll enter it anywhere between $34 and $34.51. So we're going to make a range. It's going to be a stop limit order. So we're going to enter with a stop limit order, and that is one order. I just want to let you know. We're going to enter it with a stop limit order. It's when you enter that, it's going to prompt you for two numbers. The first one is your stop, the first one is your limit. It's basically saying I'll accept the stock in this range. Okay, we will get in at $34, and we will have the limit at $34.51. And by all means, if it opens lower tomorrow, say like if it opens at $33.75, yeah, go ahead, buy. It's probably a throwback, an excellent opportunity to get some shares at a bargain. So that's how we're going to get in. Our exit stop, if this trade does fail, is a close under $33.74, and then we'd exit the next day on a progressive stop or a trailing stop. And we have our targets of $36. And I told you what to do for tomorrow. So as always, now we calculate the risk to reward ratios. Our target is $36, so say we get in at $34.25. And that means that our reward, as I'm going to write over here, is $1.75, and our risk is 34.25 minus 33.75, which is 50 cents. Now, of course, if you've listened to my other videos, the higher the risk-reward ratio, the better. And you're going to notice from this one that the ratio isn't that high. It's only, let's see, 175 divided by 50. It's only 3.5, and our bare minimum is 3. So you might be thinking, okay, what's he doing? But you must adjust for probabilities. I already told you that an upward breakout from a descending triangle very often, 84% of the time, hits its price target. That means it only has a 16% failure rate. So adjust these probabilities. So say, okay, I have a 16% chance, 0.16, of losing 50 cents per share. So our adjusted risk is 0.08. And that's just the numbers, just a ratio. Our adjusted reward is 1.75 times the 84% success rate, which is 1.47. Now we do the ratio between these two. 1.47 divided by 0.08, and our actual probability adjusted risk-reward ratio, and I'll get rid of these drawings, our actually probability adjusted risk-to-reward ratio is equal to 18.38. That makes this trade very favorable. I told you in another video that for the probability adjusted risk-to-reward ratio, I will accept 6 as a bare minimum. This is more than 3 times the bare minimum, so we have a good trade in our hands. Alright, so you know what to do tomorrow. Enter anywhere below 34.51. You can just put in the stop order just in case it opens and something catastrophic happens and it drops 8%, which I don't think will happen, just as a safety measure. We will exit the trade with a loss if it closes below 33.74, and our target is $36, where then we will choose whether to buy or sell. Our probability adjusted risk to reward is 18.38, which is very favorable. And finally, just to see what else is going on, both stochastic indicators have not issued a sell, and they don't look like they will be issuing a sell anytime soon. Alright, any questions? Please post in the comment box as usual, and thank you for watching and happy trading.